Everyone's telling you AI is the future. $1 trillion valuations, chips flying off the shelves, every company slapping AI powered on their pitch deck. But here's the question nobody wants to ask out loud. What if this is 1999 all over again? And what if that's actually good news? Rewind to the late 90s. The internet was real. Everyone knew it would change everything. So investors poured money into any company with .com in the name, profitable or not. Pets.com, Webvan, dozens more burned through hundreds of millions and disappeared. When the crash hit in 2000, the Nasdaq lost nearly 80% of its value. Trillions evaporated in months, but the internet didn't die. Amazon survived. Google was just getting started. The fiber optic lines and data centers built during the boom became the backbone of the next 20 years. Fast forward to 2026, and the parallels are hard to ignore. Nvidia's valuation has pushed past $4 trillion. The big four, Microsoft, Meta, Amazon, and Google, are pouring an estimated $650,700 billion a year into AI data centers and chips. And that spending is growing faster than the revenue AI is actually bringing in. Surveys now show more than half of fund managers openly call AI stocks a bubble. 5 companies alone make up close to a third of the entire S&P 500, the tightest concentration in over 50 years. Even the IMF's chief economist has publicly flagged the risk of a technology bubble forming. Sound familiar? It should. Unlike the cash-burning dot-coms of 2000, today's AI giants are genuinely profitable. Nvidia isn't a story stock running on hype, it's posting real revenue and real margins. And most of this build-out is being funded from cash flow, not debt. So the more likely outcome isn't AI dying the way pets.com did. It's a correction, a painful reset where overvalued names fall hard, weaker players get wiped out, and the market reprices around whoever actually delivers. So how do you protect yourself if or when this correction hits? 1. Separate the technology from the stock price. AI doesn't disappear because a stock drops 40%. 2. Watch your concentration. If a big chunk of your portfolio is a handful of AI megacaps, you're carrying more risk than you think. Diversify across sectors, not just different flavors of the same trade. 3. Favor companies with real revenue and real margins over pure narrative and hype. 4. Keep some cash on the sidelines. Corrections create some of the best buying opportunities in a generation, but only for people who aren't fully invested when it happens. 5. Don't panic sell into the crash itself. The investors who got hurt worst in 2000 weren't just the ones who bought pets.com. They were the ones who sold Amazon at the bottom. Because here's the pattern that keeps repeating: railroads, radio, the internet, now AI. Every transformative technology gets overhyped, overfunded, and crashes back to Earth. And every time the technology survives, just with different winners. The dot-com bust didn't kill the internet, it cleared out the noise and made room for Amazon and Google to build the next 20 years. AI's correction, whenever it comes, will probably do the same thing, so don't fear it. Understand it, prepare for it, and be one of the ones still standing when it's over. This isn't financial advice, just history rhyming. Do your own research before moving your money.